Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Thursday, everybody. Let's begin with a quick economic update. This week saw the publication of new trade data for the month of August. China's exports grew at their fastest pace in nearly 1.5 years in August, suggesting manufacturers are rushing out orders ahead of tariffs expected from a growing number of trade partners, while imports disappointed amid weak domestic demand. Exports grew 8.7% year-on-year in value last month, the quickest since March 2023, but imports increased by just 0.5%, missing expectations for a 2% boost and down from the 7.2% growth a month before. The mixed trade data highlights the challenge facing Beijing as policymakers try to bolster overall growth without becoming too reliant on exports, especially given ongoing chronic weak consumption. Indeed, the low import number reflects this very weakness. Zhou Maohua, a macroeconomic researcher at China Everbright Bank, speaking on the numbers, expressed, quote, "The strong export performance and trade surplus are favorable to economic growth in the third quarter and whole year. However, the global economic and geopolitical environment is complicated, and China's exports face a lot of headwinds." End quote. Chinese exports have been a bright spot for an economy struggling with a housing slump and deflation. However, the influx of cheap goods to global markets has sparked backlash in the United States, South America, and Europe, casting doubt on the sustainability of Beijing's growth strategy. Indeed, on Tuesday this week, after unveiling plans to slap tariffs on China-made electric vehicles, steel, and aluminium, Canada said it is considering surtaxes on additional Chinese goods such as critical minerals, batteries, and semiconductors. Canada said it is seeking input from households, provincial governments, unions and businesses on such additional surtaxes, with consultations ending on the 10th of October. And it's not just the West imposing tariffs. Brazil has raised tariffs on steel alongside Chile, while South Africa imposed a 10% levy on solar panels in July. Indonesia extended duties on cheap textiles this month, and Thailand has increased VAT on low-value imported goods from China. Zhang Jiwei, chief economist at Pinpoint Asset Management, observed on the trade numbers from this week, quote, "China's economy continues to show diverging trends with weak domestic demand and strong export competitiveness. The question is how long exports can stay strong given the weakening U.S. economy and the rising trade tension." End quote. Investors were not too impressed with the data. China's benchmark CSI 300 fell as much as 0.7% before erasing losses to close 0.1% higher. Chinese 10-year government bond yield inched towards a new record low. Raymond Yang, chief economist for Greater China at ANZ Banking Group, observed in a note yesterday, quote, "The weakness of imports in China mirrors its weak domestic demand. The strong trade surplus will trigger many concerns of China's overcapacity, the topic of interest of the US and European policymakers." End quote. And Michael Pettis, professor of finance at Peking University, observed yesterday, quote, "Not sure why analysts expected weaker export growth, nor why they see faster than expected export growth to be a good thing. It just means that the demand side simply cannot keep up with production, which isn't especially strong. Exports in August rose 8.7% in dollar terms from a year earlier versus expectations of 6.6%. Meanwhile, in spite of low expectations for import growth, 2.5%, imports nevertheless seriously underperformed, expanding by just 0.5%. The result was a monthly trade surplus of $91 billion, one of the highest ever on record. The important part here is that exports are not driving growth. They are growing faster than production only because domestic demand remains weak." End quote. Now, speaking of trade and tariffs, this brings us to developments in EU-China relations. While in Shanghai, near the end of his visit to China this week, yesterday, Wednesday, Spain's Prime Minister Sanchez told journalists in response to a question about tariffs that, quote, "We need to reconsider, all of us, not only member states, but also the Commission, our position towards this. We don't need another war, in this case a trade war. I think we need to build bridges between the European Union and China and from Spain. What we'll do is to be constructive and to try and find a solution, a compromise between China and the European Commission." End quote. The same day, German Chancellor Olaf Scholz joined Spanish Prime Minister
Sanchez in calling for the European Union to drop its plan to impose extra tariffs on Chinese-made electric vehicles, potentially undercutting the bloc's primary tool for pushing back against Beijing's state-backed industry. Germany and Spain both have massive financial incentives to avoid a trade war, of course. Germany's Volkswagen and BMW would be hit hardest in a tit-for-tat trade spat, as they collectively sold 4.6 million cars in China in 2022. Although, as we will see in our next development, the attractiveness of the Chinese market is beginning to fade. Spain is the EU's second largest car manufacturer and is seeking to attract investments from China to develop its own EV industry, part of the reason behind Sanchez's trip there this week in the first place. Spain is also the biggest EU supplier of pork products to China, both very vulnerable industries. Analysts argue that China's goal is to convince enough European countries that the tariffs are a bad idea, so they will oppose or water down the final levies. Noah Barkin, an analyst at research house Rhodium Group, who writes often on EU-China relations, described the Spanish leader's statement as a, quote, litmus test of the EU's China policy, end quote, explaining, quote, we can't know what carrots she offered Sanchez or what sticks he threatened him with during their meeting, but reversing course on a policy issue that is so central to European credibility and leverage with Beijing so late in the game, and during a trip to China to boot, is a damning indictment of Sanchez's foreign policy mettle and sophistication. End quote. One carrot may be clear: investment. Sanchez's comments came one day after Chinese company Envision agreed to build a $1 billion plant in Spain making hydrogen electrolysis, a product used to produce low-emission hydrogen from renewable sources. Alicia Garcia Herrero expressed yesterday, quote, Sanchez's change of position is not only a problem for the Commission, but also for the EU and Spain. Already 55% of Chinese exports of EVs go to the EU. As more countries impose tariffs on EVs, the EU might end up absorbing even more of China's excess capacity. End quote. Beijing may be looking at Italy as the next country to try to pull away from the EV tariff consensus in the EU too. UK-based Reuters reports today, citing an unnamed source, that Commerce Minister Wang Wentao is due to hold talks with Italian Foreign Minister Antonio Tajani and Industry Minister Urso in Rome. Next month, China EV maker Geely is set to launch a China-made battery electric car factory in Italy. We end this part with this observation from veteran China analyst Bill Bishop from today. Quote, it is not clear his, Sanchez's, views will be enough to sway enough EU states to vote against tariffs on PRC exports later this month, but it is not a great look to flinch like this in the PRC. It is also a reminder of how Xi could have had much of the EU in the palm of his hand if he had not decided to wrap that hand around Putin. And even then, top EU leaders may still be wobbly. How will the EU react if the US declares the PRC-connected vehicles, which most cars and all EVs are now, are security risks and so are banned from the US? Will they ignore the US views on security risks? Will they be allowed to drive near or into NATO bases? It doesn't feel like everything has really been thought through. End quote. Next up, we have one more development to cover, but just quickly, if you're getting some value from today's episode of China Update, don't forget to hit the like button. If you'd like to see the channel grow, liking, subscribing, and sharing is a tremendous help. It is the only way to keep the algorithm happy and show this channel to new people. If you hit that bell notification, you'll be on top of these updates as soon as they're released. Patreon and Buy Me a Coffee links are also in the description for those who want to help keep the channel financially sustainable. Thank you so much, everybody, for the ongoing support. The second development in EU-China relations we need to cover from this week is the European Union Chamber of Commerce in China issuing its annual position paper that, quote, details the challenges faced by European companies operating in China, end quote. The paper provides more than 1,000, quote, constructive recommendations to the Chinese government on how they can be resolved. End quote. Some of the findings of the report are quite dire. It argues that foreign businesses operating in China are at a, quote, tipping point, end quote, teetering on the edge of the nation's rapidly deteriorating economy as their declining investment return outlook may no longer justify the mounting risks. The paper said many investors are now confronted with the reality that the problems they face in the Chinese market may be, quote, permanent features that require a substantial strategic rethink. End quote. 70% of respondents to the Chamber survey said overcapacity in their industries had driven down prices. About 44% of respondents were also pessimistic about their likely profitability over the next 2 years, a record high. The paper cited a 29% year-on-year fall in foreign direct investment in China in the first half of 2024. The paper further expressed, quote, with national security considerations increasingly being balanced against and sometimes taking precedence over economic growth, it raises the question of whether Chinese officials have sufficient space to introduce pragmatic, pro-business policies. We saw in our business confidence survey that 52% of our members are planning on cost-cutting in China. 26% are planning on reducing their headcount. So if you want to change these developments, the time is now. End quote. In response to the paper, Mao Ning, spokesperson of China's Ministry of Foreign Affairs, expressed, quote, China will continue to firmly promote high-level opening up, create a market-oriented, rule of law and internationalized business environment, and provide more opportunities for enterprises from all countries, including EU members. China remains and will continue to be a critical engine driving global economic growth and a promising land for investment and business ventures from around the world. End quote. Apparently the EU businesses surveyed in this paper did not get the memo. The president of the EU Chamber of Commerce unpacked some of the report this week, expressing, quote, the big that has changed relative to the period before 2021 is the fact that we have seen that the domestic economy in China deteriorate quite rapidly, and that means that, in addition to the perennial issues we've been facing in regulatory terms, we're now beginning to face issues in terms of our ability to make money on the Chinese market. While China still holds significant potential, this situation urgently requires more action from the Chinese government, not more action plans. End quote. He then put things in very stark terms. Quote, if you have both a complicated market and your returns are lower than the global average, why China? End quote. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a great Thursday, and I will see you all tomorrow.